Hey, welcome back. Despite pretty much doubling in the past year and a half, Stellantis is even now relatively cheap, and as you're about to see, they seem to be in a very good position to do well in the future. Since they had the merger, they keep breaking records, and last year was no different, with new records in net revenues, profit and cash flows. The industrial free cash flow was 12.9 billion, which is still very good for a market cap of 70 billion, and I remember making my first video about Stellantis when this was like 35. The market share is slowly declining, but overall they did sell more vehicles, and this is, however, with significant strikes in the US last year. They also had an impact on the year as a whole, so keep that in mind. To see the potential of such a merger, out of 12.9 billion in industrial free cash flows, they generated 8.4 billion in net cash synergies. Not only that, but imagine how much more leverage they have when negotiating, be it with suppliers or even governments. By the way, the industrial free cash flow is basically the money they make just from selling or renting cars, and it doesn't include financial services. They are doing a bunch of investments and restructuring and stuff, but you can see all the numbers in the report. I think it's a good idea to separate them because adding financial services can mess up the working capital and ultimately the cash flow, but mostly on paper. Still, they aren't hiding something, and this is common with companies that also offer this kind of financial services. They have current assets of 91.5 billion, of which 43 billion is in cash, which almost covers the total liabilities, so they are doing very well from this point of view. Think about how much they can do with that money. They can literally buy the two biggest lithium companies on the planet needed for EVs and still have money to almost do it again. They won't, of course, but they made many smaller investments recently and still have a lot of money. So you can see that there is a lot of potential if they use it right. They also raised the dividend to 1.55 euros, a 16% increase, and doubled the buybacks for this year to 3 billion. For the current price, that's a yield of around 7% plus 4.5% in buybacks. For my average buying price, it's pretty much double these amounts, but even today this is a very good yield. I really don't like buybacks at all-time highs, but at least they are in a very good position to pay them. Despite the yield being high, the payout ratio for buybacks and dividends is not that much, so that's pretty good. So overall a very good year, despite labor issues and generally a bad environment with high interest rates, inflation, supply chain issues and so on. They see a turbulent year ahead, but overall they are optimistic in the long-term targets. If they reach the cash flow target, they are still at a ratio of like 4, which is extremely cheap, especially when you add like 50 billion in cash and securities. For a reference, they have significantly more cash and cash equivalents than Tesla's property, plant and equipment, so if they use it right, this money can really make a difference. And I want to mention again how much they are investing. They recently announced another 103 million investment in a factory in Hungary to support the EV production. And in the past years, you can constantly see many strategic investments, including some in mining companies that are very important for EVs. Not to mention that if the EV transition has some issues and is taking longer than expected as the market is currently worrying, they have a very solid business to fall back to. Not only that, but having such a huge company comes with a lot of leverage. We saw Italy being pretty upset about it recently, but this is the reality we live in, and every big company does that. European countries especially really have to incentivize instead of deterring local production, because otherwise Asian, especially Chinese car manufacturers will end up hurting your economy. In this case, Stellantis makes around 90-something% of the cars produced in Italy every year and represents a good chunk of the country's GDP. And look, for me, the main issue is the competition coming from China. Many key people in the industry have warned about them, including Stellantis' CEO, and they are indeed probably the number one issue. We can see that many American and European companies, including Stellantis, don't have a significant market share in the Asia-Pacific region. If this expands into their home markets because of EVs and this environment becomes much more competitive, then they would have serious problems. Still, with some of the best financials in the industry, they should be in a good position to fight it, but I don't mean to downplay this very significant risk. This can really affect the margin, the market share, the growth and everything. By the way, Stellantis also bought a 1.6 billion stake in a Chinese car maker, which I think is a very smart move and a nice way to utilize their money. And you know, they still have some of the highest margins in the industry, and given the financials, I think they have the highest chances of doing well in case things get worse. But ultimately the management is going to play a very important role, but in this case I wouldn't worry too much. I like the previous investments and how much they developed the company in a good direction in such a short amount of time. Lately, the environment has been affected by several factors, including the pandemic, inflation, high interest rates, supply chain issues, commodity price hikes, and so on. We can see that even today the market still hasn't recovered to the post-pandemic levels, but it's slowly getting there. But a big opportunity for the industry is going to come from rate cuts, because this would theoretically boost the demand, especially if we don't see a recession. As for a valuation, let's look into 3 scenarios and see how Stellantis could perform. In a bad scenario, let's say the competition from China really heats up and they make only 5 billion per year. If the market is trading them at 10 times that amount, that's a market cap of 50 billion, so a price of around 16.2, meaning 25-30% less than today. If it happens in, let's say, half a decade, adding the dividends, I would still be up if I buy today. Even then, they would easily afford to pay a 3-4% dividend for that price, which is definitely not bad. By the way, an especially bad scenario to keep in mind would be a recession, because this is probably one of the most vulnerable industries out there. If it happens, the stock would easily crash 60-80% or even more, because the market is never going to be rational in such a scenario. But you know, I'd probably double or even triple this position if that happens, so I can't say I'm worried about the possibility. In a scenario with some competition but good synergies and so on, let's say they stabilize at around 10 billion. For a ratio of 12, that's a market cap of 120 billion and a stock price of around 39. So a roughly 70% increase, or pretty much a 2x with the dividends by 2030, and this is a very conservative scenario. In a better scenario, let's say they reach the 20 billion target in 2030, which is around a 7% compound annual growth rate from the previous year. This can happen even with higher competition, because so far we've only seen what they can do in a pretty bad scenario. For a ratio of 15, that's a market cap of 300 billion, meaning a price of 97.2. That's a profit of around 300% plus the dividends. I'm not going with the best case possible because I want a margin of safety, but even at the current price, they have a lot of potential. And from the price when I first talked about them, I seriously think that they had a 10x potential. Honestly, I wouldn't mind a recession or something that would make this cheaper, because I'm ready to add a lot more. And look, I'm recording this section before I see the results. I don't care if they are up or down, in fact I wish they would go down, because again my focus is the long term. Them having a good or bad half a quarter makes absolutely no difference. Overall, Stellantis remains one of my favorite investments, and even after growing so much lately, I believe the stock is still relatively cheap. The financials are very good, the management is great, they are developing well, and the dividend is nice and will probably be even better in the future. I like them from every point of view, from a growth, value and dividend investing perspective. Even in an environment like today with high interest rates, they still manage to do very well. Talking about recessions, this is definitely on my buying list in case we get there. By the way, VW is also pretty interesting at the current price, so if you want I can make a video about them as well in the future. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.